All right. Good afternoon, everybody. We're going to go ahead and get started here while we still have a bunch of people filtering in. For those of you that don't know me, my name is Ryan Melliker. I am president and co-founder of Lodging Analytics Research and Consulting, that we refer to as LARC for short. Before we jump into the presentation, I'm going to highlight a few things for everybody. Number one is this webinar is being recorded. So if you have to hop off at any point in time, don't worry, you'll be able to watch the recording. The recording will be posted on our website at larkanalytics.com, hopefully later today, if not by tomorrow. Number two is we're going to get the question at least a half dozen times, I'm sure. Katie's prepared for it. We are going to send out the slide deck to everybody that has registered for that has joined the webinar. So if you're on the webinar, you will get the slide deck after the webinar. You don't need to ask whether you're going to get the slides. The answer is yes. Number three is, as hopefully you're all familiar with Zoom by now, in your taskbar, you have a Q&A option. If you click the Q&A, you can lob a question in. After the presentation, we're going to walk through all the questions. Katie from my team is going to help coordinate that, make sure we don't have too many redundancies, things like that. So feel free to throw a question in there at any point in time throughout the presentation, and we'll hit them at the end. And the last point that I'll mention is that if we don't get to your question, feel free to email us at information@larkanalytics, LARC analytics.com. Or if you want to learn more about any of our products or offerings, feel free to email us there as well. We stay on top of that inbox. We're usually pretty responsive. With that, we've got a lot of ground to cover today, so I'm going to start to jump in. So this is what we're going to go through. There are going to be certain points that I'm going to kind of spend a little bit more time on, others that I'm going to, because they're more relevant in the current environment, others that I'm going to spend a little bit less time on. But we're going to kind of hit all of this as we over the course of the next hour. And I'm going to jump right in, starting with a review of the industry now. As we think about the last 6 quarters, the last 6 quarters of hotel performance across the U.S. What you're looking at here is supply, demand, occupancy, ADR, and RevPAR growth on a year-over-year basis over each of the last 6 quarters. What you will notice is one of these quarters does not look like the others, right? 1Q 2023 still comping against soft Omicron comps, really outperformed. And then you saw a meaningful pullback in the years that followed. And we gradually saw RevPAR growth decelerate throughout 2023 and into 2024. It was only up 2.7% in 2Q of last year, then 1.8, and then 1.5 by 4Q. And then it dropped to 0% growth in 1Q 2024, but picked back up in the second quarter to 2.5%. Why did we see a little bit of an acceleration in the second quarter from the first quarter after we were seeing a clear negative trend? 2 reasons. Number one, we're finally now comping against some of those softer numbers. That's number one. Number two is you had a couple calendar dynamics that impacted 2Q that didn't, first of all, you had the Easter calendar shift, which certain markets benefited from the Easter calendar shift in 1Q, but by and large, it was a negative headwind in the first quarter and a positive tailwind in the second quarter. The second thing that happened in the second quarter was you had the total solar eclipse across the United States in April. Those things drove RevPAR to accelerate. Unfortunately, those are more transitory and not permanent. We believe 2Q will be the highest quarter of the year in terms of RevPAR growth. Interestingly, what I'll highlight as well is that U.S. GDP growth was up 2.5% in 2023. It moderated meaningfully in the first quarter and then picked back up in the second quarter to 2.8. So we saw that kind of make it in line with what we saw with RevPAR in the first and second quarter. The expectation from Moody's is that it's going to pull back to 1.8% growth in the third quarter and just 1.5% in the fourth. So just something to be mindful of. Now, that's nationally. Now, if you look at the market level, and here when we talk about the market level, we're really just focused on the dynamic here that not every market is going to operate like the US average. There's wide bifurcations. The dark blue columns on this chart are 2023 year-over-year RevPAR growth. And you can see it varied widely from market to market, from as high as 20% to as low as negative 10%. So just keep in mind, that's a pretty wide band that markets operate within. Just because the U.S. industry may be performing well or projected to perform well or poorly doesn't mean your market is going to perform well or poorly. And then for 2024, which is the light blue, that's our forecast for 2024 that incorporates half of the year's actuals and the remaining half of the year in forecast. You can see also pretty wide range, ranging from plus 10% to minus 10%, depending on the market. So just some things to keep in mind as we talk about the U.S. and then drill into the market specifically. The U.S. is not the same as every market. Moving from the top line down to the bottom line, as we looked at last year, 2023, we saw decent RevPAR growth fueled by that first quarter, like we just highlighted. It was also really driven by ADR growth, which accounted for the vast majority of RevPAR growth. Flow through to hotel EBITDA across the U.S. wasn't bad, almost 8%, but it wasn't great when you think about the fact that so much of the RevPAR growth came from ADR, but wasn't bad nonetheless. But unfortunately, despite really strong EBITDA growth as we moved through 2023, the outlook for cash flow growth started to slow on two fronts. Number one was, NOI growth really moderating and potentially even declining in certain periods in late 2023 and the outlook for 2024. And number two was interest rates, cost of debt going up, and then cap rates increasing. And because of that, you actually saw values only increase 2% last year, well below the 8% EBITDA growth. Now, as we move forward and we think about kind of, everybody's really focused not on the past, but it's always important to understand the past to be able to understand the future. As we move forward, we're going to focus on the three core demand segments and the economic factors that are driving them and our views for them. We're going to start with corporate, then we'll jump into group, and then we'll jump into leisure. And they're all a little bit different, and our views for 2025 are different from 2024. So first of all, when we talk about corporate, we get the question time and time again about office utilization and the hybrid work environment. And is it here to stay? Are we seeing a continued ramp up in office utilization and things like that? The reality is there's tons of anecdotes. You can read all these headlines. It doesn't matter when you're looking. Google it. You'll find a bunch of headlines that point to, oh, the return to office is picking back up. Things are accelerating, right? We see this all the time. Why do we care about it? Because if office employees are going back to the office more regularly, then there will be people that want to go visit them and meet with them in their offices, and that's good for corporate transient demand. If they're not going back to the office more regularly, then that is less likely to happen. Now, what I'll tell you about the hybrid work environment is that there are pros and cons for the hotel industry. The first pro is, the first con obviously is less corporate transient demand, like we just talked about. But if people aren't in the office as much, that means companies and team leaders are trying to get people together more frequently. That translates into bringing more people to conferences and conventions, and it translates to doing more retreats or in-house group meetings. All in all, that boosts group demand. And then on the leisure side of things, if people have the ability to work remotely, they're more inclined to travel for more long weekends over the course of the year, and that boosts leisure demand to an extent. So there are some positives and some give and takes. Now, obviously, we've been in this environment for a while now, so we have a decent sense of how all that unfolds, but it's just important to keep that perspective. And like I said, as you look at these headlines, hey, people feel positive, but the reality is, if you look at data from Castle Systems, and Castle Systems isn't the end-all be-all for office utilization data, but where it's really helpful is to see trends, and are we seeing things change? And the answer is, for almost 2 years now, office utilization data has been relatively stable at about half of 2019 levels. We're just not seeing a big movement any longer. Things have kind of plateaued out. So despite all those headlines, we don't necessarily have the view that we're seeing a change, and we're certainly not seeing it in other metrics. So our view here is that this hybrid work environment is kind of here to stay. And while we saw some pickup in corporate transient demand tied to return of office earlier this year, we think 2024 is really that new normal. The way we think about it is 2024 is kind of a normalization year where leisure demand is pulled back to a more sustainable level, and corporate demand has kind of stabilized at the level it's going to stabilize at. So that's just important to keep in mind. Now, a couple of things that we think are worth highlighting is that two of the factors that have historically two of the factors that have historically driven corporate transient demand growth are corporate profits and the stock market. When we think about those two factors, they've historically driven corporate demand growth, but not so much over the past few years. Why? Because coming out of the pandemic, office utilization became a huge factor, right? It's very possible that as office utilization starts to stabilize like we think it is, you will see corporate profits and the stock market growth become a bigger factor again. Now, keep in mind, corporate profits declined in 23, corporate transient demand growth improved. Corporate profits are projected to increase again this year. Again, corporate transient demand has improved modestly this year. And the forecast for next year is negative 5%, so decline. That's negative. It sounds negative. The reality is there's also a buffer built in there. And that buffer is because we're already 25% above 2019 levels in terms of corporate profits. So transient demand isn't back to 25% above 2019 levels, right? So you have this dynamic where, hey, maybe corporate profits don't have the same relationship going forward as they had historically. Same thing can be said for the stock market, which is 71% above 2019 levels. So our view here is that we think these factors become more relevant going forward than they've been over the past 2 or 3 years. But we still think there's some buffer in there that will mitigate the negative when we see pullbacks in corporate profits and or the stock market or business investment and the like. Shifting to the group side of things, we track 30 convention centers across the U.S. Hopefully that will start to work. There it goes. We track data from about 30 convention centers across the U.S. Get the data directly from local CVBs and convention centers. And this data we think is a great indicator for where big groups are going. It's not the entire group segment across the industry, but it's a great metric to give us an understanding of what's happening from a group perspective. And overall in 2023, convention room nights were up 13% year over year. Strong number that was skewed to the first quarter, as we know. 2024, we're pacing up 4%, positive, right? 2025 is pacing up 3%. So a quarter ago we were flat. And the quarter before that, we were negative. So we've seen an acceleration in 2025 pacing, which is really encouraging. The reality is 2025 is positive on a year-over-year basis. 2026 is positive on a year-over-year basis. 2027 is slightly negative, and then 2028 is massively positive on a year-over-year basis. So group should be a nice tailwind over the next few years. There could be a hiccup in 2027, but there's plenty of time for that to be made up. It doesn't seem like a big concern at the moment. And when you look at now, so that's across the country. Now, certain markets are going to outperform and certain markets are going to underperform. And if we look at the convention booking paces for next year, San Francisco is strongest. Not surprising. They're having a terrible year this year. So you get a big bounce back. Orlando and Denver also really strong next year. The weakest markets for next year, Austin, really, really soft. Austin has the convention center closing midway through next year, and that's going to have a big impact on overall convention room nights next year. And then Atlanta and Tampa are also soft. Now, shifting to leisure. As we think about leisure, the one thing to highlight here is that for the past year, we've been warning about the health of the U.S. consumer and the challenges that we had. Well, we've certainly seen that materialize, right? Now you can Google all kinds of things about the U.S. consumer, and you'll find dozens of news articles about how soft the U.S. consumer is. And we certainly saw it this summer in terms of the summer leisure travel season, where we just didn't have a lot of demand or pricing power. That being said, there's a few things that we'll highlight here. First of all, the soft U.S. consumer. July actually experienced positive retail sales growth. That may sound great at 1% growth, but if you think about the fact that inflation was 2.9%, that means that on a real basis, you had negative growth, which is not positive. So you either had pricing go down or sales of product declined. Either way, not good, right? The July Visa spending index dropped 4% from the prior month. That's the second lowest level since 2020. Second lowest level since 2020, and the lowest level outside of the pandemic in the past 10 years. And then the discretionary spending index also dropped 4%. That was the lowest level since November 22, and the third lowest level since outside of the pandemic in the past 10 years. So this general trend is not encouraging, right? Moving lower. Then there is some hope. The hope is tied to going forward, obviously. So the visa spending index, that happened, right? Those were July spending numbers, right? That happened. Deloitte actually issues a survey on spending intentions. And there is some positive, there's some positive signs here. So total spending, which is the solid line here below, they've improved since the May trough, right? But the reality is we're still negative. Flat is zero right here. So we're still negative, but we're not as negative as we were, right? And leisure travel spending has been gradually ticking up, and we've now had 3 straight quarters where we're positive above that flat zero line. Now, I will highlight that that is also tied to seasonality, so don't get too excited about it, but it is encouraging. There is some encouragement that we're off the troughs, and maybe the consumer is going to start to improve over the next next few months, and we'll talk about that in a little bit. Now, before we get too far ahead of our skis on that, it's also worth highlighting the relationship between the personal savings rate and the share of wallet that the U.S. Consumer allocates to hotels and food service. At the end of the day, this shouldn't be too surprising. When people save more, they spend less on discretionary items like accommodations or going to restaurants, right? When they save less, they spend more. Those two things go hand in hand. You have a finite pie. So which side, who's going to get the bigger piece? There's a negative 86% correlation. When one grows, the other declines. Plain and simple. The outlook for personal spending, you know, we saw an uptick in 2023 that has started to moderate. And now we've just got a general modest increase, you know, very modest. We're talking, you know, 4.6, 4.7%, relatively stable. And that should translate into what is hopefully relatively stable in terms of the accommodation share, share of the wallet. So we don't necessarily see the same level of headwinds going forward as we did a year ago from a leisure perspective. Encouraging, but not a foregone conclusion either. Now, I think it would be remiss if we didn't talk about foreign travel, whether that be inbound international or outbound. When we talk about, we're going to start with inbound international, which is the dark blue line down here. You know, year to date through July, foreign inbound travel across the U.S. is 13% up year over year, but still 9% below 2019 levels. What's important is outside of the noise related to the Easter shift in March and April, trends have basically been fairly stable, right? We're not seeing big movement. Momentum has kind of petered out. And we're hovering at that -9, -10% level relative to 2019. So we don't have the momentum, but we still have upside potential. Then let's go to international outbound. When we think about international outbound, you know, through year to date, international outbound travels up 10% year over year and 20% above 2019 levels. Now that 20% is also fairly stable over the past, call it 6 months. There's some noise here, but if you smooth out the noise, you basically see things are relatively stable. You know, so we're not seeing the headwinds from a continued acceleration in U.S. citizens traveling abroad. There's still headwinds relative to 2019, and I'm not sure we ever go back to 2019 levels, or not anytime soon. That may not be the right baseline metric any longer. But nonetheless, we're not seeing things continue to increase. Things have started to plateau a little bit. Now, what would cause this to go down or this to go up? Well, I think the obvious one right now is the strength of the US dollar. Now, a year ago, I sat here on this webinar and said, hey, you know, the outlook for the US dollar is going to decrease next year, and that's going to be really encouraging, because what that does is when the dollar decreases in value, U.S. destinations become more affordable for foreign travelers, and international destinations become more expensive for U.S. travelers, right? And that was the expectation a year ago for 2024. Part of that expectation was tied to the Fed lowering rates in early 2024, which obviously didn't come to fruition. And as a result, the dollar didn't actually fall like we thought it would. The expectation was, you know, we were seeing it, you know, momentum was turning, it was expected to decline, it started to decline, and then it'll bounce back up, right? And the expectation for this year is now that the dollar will be up year over year by year end, not down. So that's one of the big reasons why we don't actually see the tailwind from growing foreign travel like we thought we would. or from declining U.S. travelers abroad and staying domestically like we would. But today, the outlook is the same as it was a year ago, which is you're going to see a decline in 2025 and through 2026. And if that materializes, and again, I think a big component of that is the Fed lowering interest rates. If that materializes, you should see a tailwind as the dollar decreases in value. U.S. gets more affordable for foreign travelers, and we see a boost for international inbound arrivals, and travel abroad becomes more expensive for U.S. citizens. So maybe we see a little fewer headwinds and maybe even some tailwinds tied to U.S. travelers in 2025. So there's some encouragement there. Now we talk about foreign travel being a positive. It's not the same positive for every market, right? Some markets have a lot more exposure than other markets in terms of foreign travel. This gives you kind of a quick snapshot of which markets have the most exposure to inbound foreign travelers and which ones have the least exposure. Most of these shouldn't be too surprising to you. And just because you have a lot of exposure doesn't mean you have a lot of upside in terms of recovery, because every market's not recovering at the same level. And that's exactly what you see here. Markets like Dallas and DC are already well above 2019 levels. Now, I'm not saying 2019 is the new normal for those markets. Maybe it's not. Maybe there's more upside to go, but that upside isn't in the form of recovery. It's in the form of expansion. Meanwhile, you have markets like Honolulu and LA that still have not recovered, are nowhere near recovered to pre-pandemic levels. So there's still a lot of upside there. And understanding those dynamics in terms of the markets, I think, can be pretty helpful. Now, I'd be remiss if, as we talk about the economy and some of the factors that drive our outlook, I didn't mention kind of the 800-pound gorilla in the room with an election, with a debate this week, is the presidential election, right? And we're not just talking about the president; we're also talking about the Senate and the House. U.S. politics over the past quarter century has become increasingly polarized, and as it's become increasingly polarized, the bifurcation in outcomes gets more and more extreme. So, if the Democrats win or the Republicans win or it's split, what does that look like for, my business, my sector, the overall economy, all those different things? That variance is much wider than it used to be, where everybody was kind of middle of the road and it was more semantics, right? Now things are more extreme as things have gone to the opposite ends of the spectrum, not just from a political perspective, but also from economic perspective and some of the drivers of the economy. As a result, you've actually seen negative implications during periods where we've had elections. So, to give you an idea, in the year of the election, for the past six elections, we have seen GDP growth decelerate by an average of 1.1%. We have seen business investment decelerate from the prior year by an average of 2.1%. And we've seen hotel demand and RevPAR decelerate in each of the last 4 years, four presidential years from the prior year. That's the concern that we have. Why is that happening? Well, that's happening because of that uncertainty that I just mentioned. Businesses, the consumers, they're not certain what's going to happen in 2020, over the next 6 months or 9 months. So they're like, well, let me just take a wait and see approach. Let's see if this happens, I know how to position myself for that. And if that happens, I know how to position myself for that, whichever way plays out. Now, this one's also a little different. So all of that I just said is very, very true and very, very much an issue that we see over the next few months of the year that's going to weigh on hotel performance. But the other factor going on with this election year is the fact that we think risks are even further exaggerated in terms of the two sides of the spectrum, because in early 2025, the individual tax cuts passed under President Trump expire, and the Affordable Care Act health insurance subsidies expanded under President Biden expire. On top of that, the debt limit will need to be increased again in the first quarter, at least based on expectations. So these are all major issues that could, any movement one way or another in those three key points in the first quarter of 2025 could have meaningful impact on broader economic growth, positive or negative, depending on how things go. So it's very much, I would call 2025's economic growth more uncertain because of the political environment than most years, certainly even most other election years, which is something that's worth being cognizant of. as you read about these things and you see them materialize or not materialize, what that might mean for your business. Now, when we think about the broader economy, this just gives you an overview of the forecasts from Moody's Analytics that we rely on, that drive the lodging industry in our models. What you'll see is that GDP growth is decelerating next year. Job growth is decelerating next year. Unemployment rate relatively stable. Inflation slowing. Corporate profit growth turning negative. A 10-year Treasury yield relatively stable. Those are all factors that drive corporate demand that seem to be softening, right? Now, the positive, believe it or not, consumer confidence is expected to be positive over the next 6 quarters, and the foreign exchange rate is expected to decline over the next 6 quarters. So you put all that together, and oh, hey, there's actually some tailwinds for leisure. So we for the last call it year and a half, we've been talking about all the headwinds for leisure. We're now at a point where okay, we've normalized in 2024 a lot of those leisure headwinds, and we're going to start to see more tailwinds going forward. On the flip side, corporate transient, we talked about a lot of tailwinds over the past few years as we saw office utilization ramp up and kind of a return to normal. Well, now we think we've hit that normal from a corporate perspective, and that normal may not be what it was pre-pandemic. It's call it a new normal, but now we see some either fewer tailwinds or modest headwinds going forward. And then some of the core assumptions that drive our overall models. The Fed's going to raise interest rates when they meet next week, and increase at 25 basis points a quarter into 2027. Decrease 25 basis points a quarter through 2020 into 2027. Inflation is going to continue to moderate, as you just saw. The conflicts in the Ukraine and the Middle East will not escalate, and no near-term U.S. recession, though economic growth is going to be muted going forward. Any meaningful changes to any of these assumptions is going to have an impact on our models, but these are the assumptions that we think are reasonable at this point in time. With that, what you guys all want to talk about or hear about is our U.S. lodging outlook. So let's jump into what all of that means to our forecast. Now, we talked about things from a demand segment perspective, so it probably makes sense to continue talking about things from a demand segment perspective. What this chart here just shows is basically using 2019 as a baseline, where is corporate leisure and group demand over the past few years, and where is it forecasted to be? So from a corporate perspective, in 2024 is well below 2019 levels. That shouldn't be a surprise. But our view going forward, as you can see, is not any pickup. It's actually a modest erosion in that level, where we don't see positive growth from corporate transient next year or really the year after, based on the macro factors that are outlining our models from Moody's, which really forecasts really muted macroeconomic activity over the next few years. On the flip side, the light blue, which is group, is basically back to 2019 levels this year, and we continue to see it tick up, nicely over the course of the next few years. It will be about 10% above pre-pandemic levels. Very encouraging. Group is clearly one of the winners coming out of the pandemic, while corporate is one of the losers. And then there's leisure. Leisure started out of the pandemic really hot, has been moderating over the past few years. We think we kind of hit that new normal finally in 2024, and we actually see slight modest growth going forward, but it will stabilize around 15% above 2019 levels. So leisure, big winner coming out of the pandemic, followed by group, while corporate's the big loser. But going forward from 2024 as a baseline, it's group and leisure that actually looks stronger, while corporate looks a little weaker. And then if we jump into some of the other factors, supply, we talk to clients about supply all the time. Supply is a really interesting one, where at the end of the day, we don't see a lot of supply growth this year, next year, the year after that. Supply growth over the next 5 years, we have estimated at 1.0% compound annual growth rate, which is almost half of the long run average for supply growth across the US. So it's pretty muted. Supply is not going to be the big concern. That's a good thing. The challenge is that you're dealing with other factors like sluggish economic growth, short-term rentals, other factors that come into play. But supply to us, there isn't, out of the 62 cities that we issue quarterly forecasts for, supply isn't really a primary driver of concern that we have in any of them right now. Now that can change, but generally speaking, we don't think it's so bad anywhere that, oh, that's a reason why you need to stay away. Um, this is our RevPAR model. So to give you guys an idea, for those of you that aren't familiar with our models and statistical modeling, the dark blue line that you see in this chart is actual RevPAR as reported on a seasonally adjusted basis by STR or CoStar. The light blue line is the model that we've built and back tested to try to forecast that RevPAR historically. We've forecast that RevPAR historically using actual performance of these key model drivers, right? Things like unemployment rate, real GDP, corporate profits, et cetera, things that we've been talking about. We've done that so well that it has a 98.7% R squared. Now, for those of you that don't remember your stats class from college, a 98.7% R squared effectively means that our model has predicted 98.7% of all the variability of RevPAR going back to 2000. So highly accurate model historically. And then that model going forward uses the forecast for these metrics to forecast RevPAR. And there you see it. Same thing for ADR. Again, dark blue line is actuals, light blue line is the model. The drivers are a little different. 98.9% R squared, highly accurate. And when we put it all together, you see our RevPAR forecast, which is the top here, where this year we've got slightly negative occupancy growth, ADR growth at 1.8%, and RevPAR growth at 1.4%. I think interestingly, we are very similar to CoStar's current numbers for 2024. The other guys, I would say, and HVS is pretty close too. Other guys are, I think, a little higher, but I think those numbers are a little scalar. They haven't been updated as recently. As we look out to 2025, one of the things that you'll notice, and this is probably a general theme with us, is that we are more cautious in occupancy and more positive in ADR than most other forecasters. And that points to our views on corporate transient being just a little bit more sluggish, which weighs on occupancy to an extent. We don't see occupancy getting back to pre-pandemic kind of stabilized rates this cycle. But we have positive RevPAR growth of 2.5%, which is pretty similar to what STR and CoStar have. However, ours is more ADR oriented, and they actually have positive occupancy growth, whereas we do not. PwC positive occupancy growth, as well, and more muted ADR growth. And then HVS, also, positive flat occupancy and not quite as strong on the ADR front. So that gives you an idea of how we differ from some of the other forecasters. I'll tell you why you should rely on us more in a minute. But I'm a little biased in case you couldn't tell. Now, with regards to quarterly forecasts, I talked a little bit about it before, but seasonality has had a big impact on this year. So in 1Q, Easter was a headwind. In 2Q, Easter was a tailwind. In 3Q, the Jewish holidays are shifting from last year in September into all of them being in October this year, which is a tailwind for September, and then a headwind for October. So you see that showing up in the third and fourth quarters, and then next year, all those unwind. So lots of noise related to quarterly performance. We're driven by the calendar shifts. Just something to keep in mind. We do still believe that 2Q is the strongest quarter of the year, which is something that we had expected going into the year. Certainly seems like it's playing out. We think 3Q will be second, aided by that Jewish holiday shift in late September. And then 4Q will also be softer. Next year, you'll see strength tied to the soft comp from the Easter shift in the first quarter, then a tougher comp in the second quarter. And then as leisure is improving, we've got positive growth in the third quarter, despite tougher comps, before we see more softness in the fourth quarter. From a price class perspective, this is year-over-year growth for 24 and 25. What you see here basically is in 2024, the dark blue, 2024, the dark blue, clearly you've got strength at the higher end and a little more softness at the lower end. This is tied to group and corporate strength, whereas this is domestic leisure struggling. As we look to 2025, with group and inbound foreign leisure improving, you're going to see strength across the board here. Whereas with domestic leisure improving, these guys now turn positive from being negative. So the lower end segments being the massive underperformers. We're not saying they're going to outperform next year, but at least they're not going to be negative again. And we think that's encouraging. Relative to 2019, the clear segment winner has been leisure. I'm sorry, luxury, which has dominated from a class perspective, while the lower end has really, really underperformed, which is interesting because it really outperformed early in the recovery and then has since just languished. We'll see if it can gain a little bit more footing going forward. Now, why, I mentioned earlier why you should trust us. Well, I think first and foremost is we try to use only the best data sources. I shouldn't say we try, we do use only the best data sources. We are very picky about the data that goes into our models and how we're forecasting. We use STR or CoStar as a baseline for all of the historical operating results that go into our models. We think that they are by far the best provider of historical operating results across the US and across every market in the US. We're very reliant on their data. There are other guys out there that have operating results across the US. And while they may have some really, really interesting products, and they do, and I don't want to discourage people from using them, I do want to highlight that when it comes to simple occupancy, ADR, and RevPAR metrics, STR's data has so many more hotels contributing, so much more accuracy than anybody else's, that anybody that's not using that as their baseline is either cheapening out or doesn't understand the quality of good data. Economic forecast, we use Moody's Analytics. We're the only forecasters for the hotel industry using Moody's. I was on a call with a prospective client this morning, and they asked, "Why do you use Moody's?" And I asked a simple question: "Do you know who Moody's chief economist is?" And they said, "Yeah, it's Mark Zandi." I said, "Any other companies you mentioned, do you know the chief economist?" I said, "No." I'm like, "Why do you think that is?" There's a reason. There's a reason why Mark Zandi's on CNBC or Bloomberg every week, and it's not just good marketing. It's because their forecasts are better. They're logical, they're sound, they're detailed. We rely on that. The other guys don't. Convention pacing data, I talked about the importance of that before. I believe we are the only forecaster that gets that data from 30 convention centers across the US and builds that into our models. Makes a huge difference in a lot of convention-oriented markets. Health of the office market is important from Moody's, supply pipeline data, short-term rental data, historical cap rates from CoStar. You get the idea. And how have we performed as a result of that? Well, if you look at the forecasts going into the upcoming year, so think about it like now for 2025 or the next couple of months for 2025. Where were we going into 2021? Well, we were by far more accurate than anybody else on occupancy, ADR, and RevPAR. Was 2021 an anomaly? Absolutely not. 2022, we were spot on occupancy. We were $6 higher than anybody else on ADR, and we still came in light. We also warned our clients we thought our number was light, even though we were $6 above anybody else, still closer to anybody else on occupancy, ADR, and RevPAR. 2023, we believe in accountability and transparency, so we'll highlight this. We were not the best forecaster last year for the US. We believe the gold medal goes to PwC, who was the only forecaster that was within 1% of occupancy, ADR, and RevPAR growth for 2023. That being said, only us and PwC were within 1% for occupancy and ADR growth. Other guys that were close on RevPAR was because they were wildly different in occupancy and ADR in negative direction, opposite directions, and that canceled each other out to an extent, but I call that more luck than skill, in my opinion. But I'm biased, as we talked about. And then across the 62 markets that we issue quarterly forecasts for, in 2022, we were more accurate in about 70% of those by a factor of almost 2 times. And in 2023, we were more accurate also by in almost 70% of those markets by a factor of almost a full percentage point. Now, that tells you why you should trust our top line. Now, let's talk about things beyond the top line, things that are really important right now, and really addressing a major 800-pound gorilla in the room, and that's labor costs and what's going on across the industry in the nation today. So, we think this is a major factor that I think is getting a good amount of attention, but trying to understand the implications is harder. There are a lot of cities undergoing collective bargaining agreement negotiations right now. Those negotiations have stalled out, and many of those, and that translated into strikes last week in, I want to say, Honolulu, Seattle, San Diego, San Francisco, Boston, DC, Baltimore, probably a handful of others. Those collective bargaining agreements are a major issue that need to get addressed, and it's not going to be simple. Let's talk about why the owners and the unions are always going to butt heads to an extent. Like we're not going to argue against that. But I think this is a little bit different and a little bit more extreme. Let's talk about why. I think first from an owner perspective. From an owner perspective, if you own the average hotel across the US, your hotel EBITDA is 16% above 2019 levels on a nominal basis. We're just talking nominal here. 16% above 2019 levels. Margins are almost back to 2019 levels. You're like, okay, things are all right. Not great, but they're fine. If you own a hotel in one of these, what we call union markets. Now we talk at them, these are union markets, not because every hotel in the market is unionized, but because they have an outsized exposure to collective bargaining agreements and hotel unions. In these markets, EBITDA, instead of being up 16% on a nominal basis in 2023 from 2019, was down 4%. Instead of margins approaching 2019 levels, they're still 260 basis points below. So massive difference, right? So from an owner's perspective, wait a minute. You want us to pay you how much more money when we're making, not only is our EBITDA 4% lower, but when you factor in the increased cost of debt, our cash flow is massively lower than it was. Why? This doesn't work. The metrics don't make sense to us. So that's the owner perspective. We can't do it. All right. Now let's take a look at the labor perspective. So from 2009 to 2019, the union cities, not union hotels, but these cities that have a lot of union hotels. On average, they experienced an increase in wages of 17% more than the national average over a 10-year period. So that's like 1.7% a year, right? Massive, stronger wage growth, right? Higher cost of living, get better wage growth. That makes some sense, right? However, from 2019 to 2023, the wage growth, according to the BLS, has dropped is grown 22% less than the national average. So instead of seeing much higher growth, you're now seeing much lower growth. And the labor unions are saying, wait a minute. Cost of living has gone up so much. Not only are we not growing at the same pace as the national average from a wage perspective, but we're growing at a slower pace than the national average. Why is that? Well, because most of these collective bargaining agreements were structured in 2017, 2018, 2019 before the pandemic. And when that happened, these massively elevated wage increases that have materialized over the past, call it 2, 3, 4 years, coming out of the pandemic weren't built in. So union contracts ended up seeing much lower growth than you saw than the average hotel did that was not unionized. So then bottom line is those agreements back in 2018, 2019 were very good for hotel owners. But now those, relative to what ultimately unfolded, not necessarily very good relative to what expectations were at that time, but what ultimately unfolded. And now we're at a point in time where, okay, the labor unions are like, hey, you guys got a good deal these last few years. It's time to, set things back, new normal, if you will. Well, what happens in that new normal? Well, in LA earlier this year, the union reached an agreement with owners and operators to increase wages 40 to 50% over the next 4.5 years and reset staffing back to pre-pandemic levels. It's a pretty big number. If all those union markets we just talked about saw their 2023 labor costs adjusted by that disparity, right? So instead of it being down 22%, it was back to, up 17% on a per year basis, not the aggregate numbers, but on a per year basis. What would that do to hotel EBITDA? Well, hotel EBITDA would drop 14%. 2023 EBITDA would be cut by 14%, right? Well, you've got properties that, can barely cover debt service at the current interest rates. And now you're talking about resetting EBITDA to 14% lower. Well, the reality is that reset may occur, but it's probably not occurring at once. Right, like you see in that LA dynamic over the next 4.5 years, this is likely to be a headwind for hotel EBITDA and and margins for these major markets not a reset today or tomorrow or next year, but gradual over the next 5 years. And it's just going to create a material headwind over the next few years for EBITDA growth and value appreciation across these markets. And now what I want to make sure everybody fully understands is this headwind is not just tied to union hotels. This is all hotels across the market. Why? Because the hotel wages are going to get re-rated across the market over the next few years. So if you're a non-union hotel, if you're a union hotel that was paying $25 an hour to your housekeeper, right? And you're a non-union hotel that wanted to stay non-union, wanted to try to take care of their employees, didn't want to have to deal with all the challenges that comes with being a unionized hotel. So you're going to pay $28, $29, right? Higher. Well, guess what happens when this gets reset and that 25 goes to 30 or 35? You're going to go up again, right? And you're going to continue to increase. So I think we're running a challenge right now where you're going to see these dynamics impact the entire market, not just union hotels, because these wage increases are that big. So it's just something to keep in mind when you look at all of those union-oriented hotels, which are basically the gateway cities across the coastal cities, plus Chicago in the middle of the country. Now, taking that aside, and let's go back to the overall U.S. outlook. Property taxes are going to grow around 4%. Our wage outlook incorporates wage growth in excess of inflation. We talked about inflation being around 2% over the next 5 years. We've got about 3% wage growth. It's excess of inflation, but also not crazy because the union component is only one part of it. Union markets are only one part of it. The rest of the industry has already absorbed a lot of those increases, as we all know. And we generally have expenses growing at a 2 to 3% clip over the next 5 years. That translates into slightly negative EBITDA growth this year, slightly positive next year, negative in 26, and then positive thereafter. With our EBITDA model, we then build out our cap rate forecast, just like the other forecasts. Dark blue line is the actuals from CoStar. The light blue line is our model. Drives the model over here, R squared to 98.5%. And that tells us that overall in 2024, we've got modest increase in supply, a modest increase in demand, occupancy slightly negative, ADR modestly positive, RevPAR growth a little bit less, which translates into ever so slightly negative EBITDA growth. But values are actually going to be positive, are positive this year, and that's driven by two factors. Number one is the outlook for cash flows is improving from 2024's levels going into 2024, and number two is the idea that interest rates are going to start to moderate and you're going to see cap rates potentially compress modestly. So that's positive in 2024. But as we take a view a little bit further out, a couple of things that you'll find is that we don't have a lot of strength, right? Things are relatively muted. RevPAR growth over the next 5 years will increase at a 2.0% compound annual growth rate. Hotel EBITDA will be slightly positive over the next 5 years, and values will increase around inflationary levels. Not overly exciting. Sorry. I wish I could tell you it was something different, but it comes down to that economic outlook that is relatively muted. How has this forecast changed from the last forecast for this year? Well, real simply, supply increased a little bit, demand increased a little bit more, so occupancy ended up being a little bit better. ADR we gave back a little bit, offsetting that strength. So RevPAR is slightly negative. RevPAR down a little bit from last quarter translates into hotel EBITDA being down and values being down a little bit from last quarter. Now, the other thing that I'll tell you about this is almost all of that change from the last forecast to this forecast was tied to 2Q actual results, which came in a little lighter than we had expected. We were thinking there was going to be a little bit more strength in the second quarter than materialized. Our outlook for 3Q and 4Q are largely unchanged. We had been forecasting about 1.5% RevPAR growth in the back half of the year, 3 months ago, and we're still forecasting that. So no meaningful shift there. When it comes to values over the course of the cycle, this cycle, the dashed line, you saw us fall much faster than following the Great Financial Crisis, and then bounced back much faster. And now we're basically in the same spot as we were following the Great Financial Crisis. The big difference is our interest rates are a lot higher than they were then. And what drove a lot of this outperformance and growth were LBOs, the leveraged buyouts that we think are less likely to materialize because of a higher cost of debt over the next few years than where we were over, at this point in the last cycle. So we see, continued positive growth, just much more muted than we saw during that cycle. Now let's talk about markets. I know everyone wants to talk about markets. These are the 62 cities that we issue quarterly forecasts for. If you want to learn about our reports, just let us know. Happy to walk you through them. Before we jump into the individual markets, the couple things I'll highlight is that we talked about GDP a lot throughout this presentation. GDP is a very, very relevant forecast indicator at the market level. At the national level, right? There's a very strong relationship between GDP growth and overall RevPAR growth and demand growth over time. We've seen that play out. You can see it in the metrics on the slide. However, at the market level, GMP, which is GDP at the market level, gross metropolitan product, that relationship totally breaks down. And it's really broken down since 2019 as we've seen less corporate demand and more leisure demand. Local jobs become less of an indicator, things like that, not as meaningful. So just as a heads up, don't just rely on macroeconomic factors. Understand the drivers of your individual market, because maybe jobs isn't relevant anymore. Maybe it was never relevant. Maybe it used to be relevant and it's not as relevant as it is now. And now you should be focusing more on your retail sales and consumer confidence or jobs in your feeder markets, things like that. Understanding those nuances is really important. In terms of 2024 RevPAR outlook, these are the 62 cities that we forecast for. Strongest growth is going to be tied to markets with outsized exposure to Asian international demand. Again, we talked about corporate transient. This is the last year where we get back to normalization, as well as strong convention paces. These also include markets that have recovered the least to date. Think like Minneapolis, San Jose, Raleigh, we're sluggish in terms of the recovery. And then bottom performers for 2024, these are markets that basically are the opposite. They predominantly cater to domestic leisure demand, soft group booking paces, and then there's Maui with the wildfires having a big impact. For next year, 2025, Maui again benefits from the soft comps tied to the wildfires. Kauai, on the opposite end of the spectrum, benefits from tougher comps tied to those wildfires. Outside of those two extremes, the strongest growth is going to be in markets with outsized exposure to Asian international demand. Though a handful of those markets that still have corporate transient recovery remaining because they're behind the national average. There's only a handful of those, and then strong convention pacing. Weakest markets are going to be those that predominantly cater to corporate transient demand, have limited international exposure, or weak group booking paces. And then we look at a 5-year outlook. You'll see our top performers tend to either have soft comps from 2023, strong markets going through major shifts, bringing added demand to the market. Think of everything happening in Las Vegas, Puerto Rico, Palm Beach as examples there. Other markets with outsized exposure to leisure demand, strong economic trends, strong international demand, group bookings, all those things lead to our top performers over the next 5 years. And then bottom performers for RevPAR growth tend to be those that don't have much international travel demand, have sluggish economic growth, soft convention calendars, or tough comps from 2023 as that baseline year. And then from a value perspective, our top performers are Las Vegas, Puerto Rico, and Seattle. These are markets we've liked for a while now. Bottom performers tend to be soft convention calendars like Austin, difficult comparisons like Boston and San Diego, elevated expense growth like Chicago, Boston, San Diego. Those are some of the markets that we're a little bit more cautious on. But before I move to the next section, I'm just going to talk a little bit about New Orleans, because I think New Orleans is an interesting one where New Orleans actually cracks our top 5 for investment this year, this quarter. And we've liked New Orleans for a while now, but it showed up in our top 5 this quarter in terms of how our models unfolded. And I just want to talk a little bit about that. So we're going to dig in a little bit further into better understanding the New Orleans market. So the first thing that we'll always highlight when it comes to any market, but certainly with New Orleans, is don't be fooled by what you see from kind of headline macro factors like job growth or economic activity. And in New Orleans, that is extremely relevant. Local economic growth is not a driver of hotel performance across New Orleans. In fact, about only 8% of all visitors to the market stay for transient business travel. This is a leisure and group dominated market, plain and simple. So we'll talk about those two things in a second. We talked about how we like leisure going forward. You also saw in New Orleans kind of a massive resetting of leisure demand in 2023, which I think was really important for, to set that market up for some success going forward. Supply growth remains muted. Only 2.6% of existing inventory is under construction. So small metric for supply growth. That's about 1,200 rooms, a little less than 1,200 rooms across the entire market. Really muted. Supply growth, that's encouraging. Let's talk about the convention center. What do we like about the convention center? Oh, let's see. Convention booking pace is up 9% year over year this year, up 7% year over year next year, up 14% year over year in 2026. It's 14% above 2019 levels that year. By the way, they're also embarking on a $550 million renovation. The convention center is not being closed for the renovation. This is happening during all these strong group booking paces as you're going to come out of 2026 with a bright, shiny new convention center. And on top of that, they're expanding what they're calling the Convention Center and Entertainment District, which is 2.4 million square foot area along the river that $1 billion being invested. Additional amenities like a music museum, a Topgolf, 750,000 square feet of office space. That's set to open in 28, 29. And on top of that, the New Orleans Exhibition Hall Authority agreed to the development of a 1,200 room Omni hotel across the street and connected to the convention center. That hasn't broken ground yet. So it's not in the 1,200 rooms that we said we're opening. That will double it. And they might say, oh, 1,200 rooms is a lot of supply. It is a lot of supply. It'll open in about 5 years. But we looked at this. So we analyzed 14 similar projects, new convention center hotels opening attached to a convention center in a major market. And there have been 14 of these since 2000. And what we found basically was that in the 5 years following the opening of the convention center, the market actually experienced annual RevPAR growth that was 3% more than the 5% prior. And annually, we saw RevPAR growth that was 200 basis points above the national average across the broader market. And then the submarket itself, think the CBD, another 300 basis points of outperformance versus the market. So that's 500 basis points relative to the national average combined. That is a huge positive, right? That's what is likely to come, not this year or next year, but down the road. So after this new Omni hotel opens, you're gonna have nice tailwinds because of something that wasn't there before, generating more demand for that convention center. And given New Orleans is such a convention-oriented market, that's a huge positive. Do we think it could impact compression into some of the secondary markets, secondary locations across the market? Absolutely. But generally speaking, it's not a concern of ours. For the market, we think it's a positive, not a negative. Our forecast model, just like the others, dark blue line is actual, light blue line is our model, 99.1% R squared. What you'll notice here is we include a lot of funky things. And why is that? Because look at all the noise in RevPAR growth historically, right? That's because this market is heavily influenced by special events like the Super Bowl, which is coming to New Orleans in January of 2025, the convention calendar, things like that. It's less oriented to GMP or jobs or office employment. So what you see in our model is you got things like retail sales and consumer confidence, which are leisure-oriented factors that drive our model, as well as convention calendar, special events, supply, and then you get some other generic macro factors like construction, housing construction, and unemployment rate that also play a role. But net model is unique and built specific for New Orleans, and you can see the historical accuracy. You can see that spike from the Super Bowl right there. Now, you leveraging our LARC GIS application, and if you have not seen the LARC GIS application, I really encourage you to check it out because it's pretty remarkable with the ability to really zoom in and pull RevPAR forecasts for any location in the country, whether there's a hotel there or a development site, you name it. We can pull data and extract RevPAR forecasts for any location in the U.S. Here you'll see a heat map of RevPAR growth across the New Orleans market. Dark blue is stronger, light blue is weaker. You can see where some of the major new things going on, like the Convention Center Entertainment District, the Caesars renovation, or the Jazzland conversion to an outdoor sports complex, where those things are going to be. The gray area, there's no hotels, no RevPAR growth. You get the idea. So focus on the blue where there's actually hotels. And then the last thing that I'll say about New Orleans is, take a look at the historical accuracy of forecasts. If you go back and take a look at 2023, going into the year in December of 2022, we said RevPAR was going to decline about 4%. The other guys said it was going to be up 7%. What happened? It was down 7%. Now, we may not have been perfect, but our forecast was a heck of a lot closer than those other guys by a wide margin. Let's take a look at the first half of this year, since we have actuals for the first half of this year. Our forecast in December 2023, we were expecting a little over 2% RevPAR growth. The other guys, a little over 12% RevPAR growth. What happened? It came in roughly flat, right? Again, by far the closest. Now, for the remainder of 2024, those other guys, which started off at 16% RevPAR growth, have come down to 3% RevPAR growth. We started off at 4 and have come down to 3. Again, pretty close. Next year, the numbers are more similar, but you get the idea here. The bottom line here is, who are you going to, if you're reliant on a third-party market forecast for any type of decision you're making, it seems like a no-brainer on which one you'd want to use. That's our view, at least. And I think the data kind of proves it out. So with all that being said, for those of you that don't know, we have 3 core product offerings: quarterly market intelligence reports, which we've discussed throughout this presentation, as well as our commission market forecast reports, which we can do for any market, any sub-market. Price class is totally customizable. And then our LARC GIS application, which I just mentioned, it's a web-based application. You can zoom in and get tons of detail about any location in the country, super granular, lots of forecast data as well. With that, if you have questions, Katie's going to go ahead and manage Q&A now. We'll try and we'll go through them. If you can't stick around but do have questions, feel free to email us at information@larcanalytics.com. Katie, what do we got?
Alrighty, we have a few people asking about the PowerPoint and the presentation itself again. So just want to reiterate that the recording will be on our website, and that if you participated in the webinar, you will get the presentation. And then, so the first question, according to your most recent report, overseas visitors stay in the US for 18 days versus domestic visitors staying 2 days. Which cities are most popular for overseas visitors? Do they typically stay in one city or several? If so, which? What is their motivation behind one place versus another?
Those are great questions. So yes, and that was through our client letter that we made public last week. You saw that data. That's not our data. We sourced it, I believe, from the U.S. Travel Association. But to answer your question, and hopefully we addressed it to an extent, these are the markets that have the most exposure to foreign inbound arrivals, according to the U.S. Department of Commerce and effectively Immigration and Border Patrol, which is really what you're looking at there. Obviously, 18 days, I would argue, are not necessarily. A, they're not staying in necessarily one city the whole time. B, not necessarily staying in a hotel the whole time. Nonetheless, it still does point to the positivity of foreign inbound travel and the implications of an increase in foreign travel having on the hotel business when that does pick back up.
Relating to the health of the consumer and projections that they will spend more on leisure travel, is there any data taking into account the idea that student loans will start getting reported to credit agencies by the end of September, leading to even less spending due to many people not paying for the past couple of years, and be a further weakening of spending?
It's a great question, and I think a lot of that is going to come down to some extent. First of all, I think it takes a lot of time for things to start to materialize in terms of the credit agencies. Second of all, the election in November is going to have a big, this is one of those factors that's going to be very, very relevant from that perspective. Now, what I would tell you, the third thing I'd tell you is that student loans are meaningful. I don't want to dismiss them, but they are not nearly as meaningful as other factors. Generally speaking, U.S. consumer debt levels are well below what we saw coming out of the great financial crisis, or really throughout most of many other periods in time. So we're not overly concerned about the debt levels. That being said, I think having to be forced to pay a bill that you weren't forced to pay is going to have implications, and there's no doubt about it. We are paying close attention to it, but I think it's not a foregone conclusion that student loans are going to have to start being repaid, in a month or two.
To what extent will a decrease in interest rates, as forecasted by the Fed, impact travel vis-a-vis corporate stocks repurchasing / company investments and construction new starts in the hotel industry?
Oh, so I'm not sure the Fed is going to for a lot of hotel construction. At the end of the day, a couple things to think about with the Fed. Number one is that, there's already a forward curve in terms of where cost of debt is. So if the Fed lowers rates next week, that forward curve isn't meaningfully changing. And that's already being priced into cost of debt today. Now, will there be a higher degree of confidence? Maybe, and in of itself is a positive. But I don't think that you're going to see a material shift in cost of debt over the next 6 months. But you will see some confidence in where things are that will help transactions move forward. I think that the biggest challenge for new development is related to not just the cost of debt, but construction costs. And the reality is, if fundamentals aren't that strong and you're not seeing material growth in cash flows, while construction costs continue to rise, if things didn't pencil out over the last 12 months, what makes you think they're going to pencil out over the next 3 years? I don't have a lot of confidence in that. I think that, that being said, developers will develop and they're going to find ways to develop, and we expect that to materialize. It's just not going to be this overarching massive acceleration when fundamentals aren't that strong. Regarding the other implications of the Fed, we have not seen, again, I think the cost of debt doesn't change when the Fed lowers rates. I think there's a forward yield curve, and that is a misconception. So I don't think the Fed lowering rates is going to translate into companies purchasing stock or increasing their investment in their business to grow it. On the flip side, I think the positive coming out of the election, you might see some tailwinds tied to that. We talked a little bit about that earlier, where as you move past the election, there will be some clarity. And instead of having a year where business investment growth decelerated and GDP growth decelerated, and demand and RevPAR growth decelerated, you see some positives. That's encouraging. But at the same time, the forecasts for next year are for corporate profits to decline. So I think that's going to be a mitigating factor without a doubt.
10-year Treasury is already lower in 2024 than displayed or forecasted for 2025. Implications?
Yeah, I think you can't just believe it or not, there's volatility in anything that trades daily, and you can't just look at it a day or a point in time. Take a look at over time, things will smooth out and revert back. If you did, there's point in times where the 10-year Treasury traded at 7%, 6-7% over the past year. That's obviously not where it netted out. So I think don't focus on a point in time. Focus on what the long-term view is.
Point of contact for hotel feasibility study.
We do not do hotel feasibility studies at LARC. We are more on the market forecasting side. Our affiliates at LW Hospitality Advisors are the ones that I would recommend for that purpose. You can contact Evan Weiss or Daniel Lesser for that. They're my partners at LARC, and they do a great job on things like that.
Is lack of supply one of the key model drivers for your RevPAR forecast? I did not see it listed as one on the slide.
Supply is a factor in our models, but I wouldn't call it a key factor in our RevPAR forecast. At the end of the day, supply gets built in. You'd be surprised that on a national level, increasing supply isn't necessarily a negative for RevPAR growth. You can actually see it as a slight positive as you get new supply, driving ADRs higher, bringing demand, inducing demand. Some of those components can be a little noisy. I'm not saying it's always positive by any sense, but supply is not a huge factor. It is a factor.
Would seem that +17 non-union wage versus -22 on union wages is a great opportunity to say unions are not the way to keep pace with the broader market versus, and then it might have cut off because that's where the question ends.
Look, I'm not going to disagree with you. I'm not going to disagree with you by any sense. But I don't think this is the forum to discuss whether unions make sense or don't make sense. I think we're trying to highlight, hey, the challenge is not whether unions make sense or don't make sense. The reality is unions are here, and this is the ramification of them going forward.
Do you plan to add in slice to the report /GIS? Example, upper upscale, mid-scale, etc.?
We add price classes into our national forecast. Our approach to forecasting is a little bit more granular than a lot of the other guys, and as a result, it be cost prohibitive to build out price class forecasts into all of our quote off the shelf reports. But we do it on an ad hoc basis for clients.
Any stats on where outbound travel is going internationally?
There's all kinds of stats. We don't have them available in this deck, but I'd encourage you to check out the U.S. Department of Commerce's website. It's pretty remarkable, the data that they're able to pull.
Is that TSA throughput is stronger than market's occupancy growth? How do you think about record throughput not equating to stronger lodging fundamentals? Airbnb question mark?
No, I wish I could tell you it's Airbnb. We actually don't see, we track Airbnb. We subscribe to AirDNA and get data from AirDNA and trying to gauge demand of short-term rentals relative to the broader industry. And it's basically around where it's been at about 4.5% revenues of the hotel industry. So not a huge component moving one way or another. The reality is a lot of it comes back to that corporate component that we talked about before. If you don't have as many people in the office, you don't have as many people to see when you travel to a new market. So if I'm going to go visit clients in Chicago, and instead of being able to see 6 clients, I can only see 3. Instead of staying overnight, I'm going to do a day trip. TSA throughput gets impacted, but I don't get a hotel room. So same type of dynamic. And that's having a big impact where you're seeing more and more day trips from a corporate traveler perspective. And and the trips that do occur don't have as many nights booked. Like if you do have, maybe you do stay over one night, but historically you would have stayed over 2.
Does that firm do market analysis? I think this is referring to LW.
Yeah, next.
What is the key driver of that ADR growth in 2025 given CPI is decelerating?
It's a great question. So CPI is not the only factor that impacts ADR growth. If it did, you would have seen very different ADRs over the past few years, right? It is one factor. It is not the only factor. As we kind of highlighted, our ADR outlook is really driven by a handful of factors. CPI is one of them, but we're looking at the personal savings rate, business investment, unemployment rate, disposable income levels. All of those factors and the outlook for those factors points to our views at the end of the day. Stronger group booking pace shrinks hotels, which gives you less inventory for transient demand, which is encouraging for an ADR perspective, gives you confidence in pushing rate. The U.S. consumer is improving, consumer confidence gets better. You have more confidence in being able to push rate on top of that. All of those things play a role. Inflation is only one of them.
And then right now, this is the last question. What
Great.
percentage of the demand pie are the 3 segments referenced? Corporate, transient, group, and leisure.
I think every year that's a little bit different and it continues to evolve. I think that rather than answering that question on a national level, I'd encourage you to better understand it at the market level that you operate within, because every market's a little bit different. You're going to see, as we talked about with New Orleans, corporate is is roughly 8%, less than 10%. That certainly isn't that national average by any sense. Whereas group and leisure are basically 50-50 split of the rest in New Orleans. So every market's going to be a little bit different. Understand the market to be able to better understand that.
We did get one more question. Okay. What is driving upper mid-scale growth in 2025 if they don't have much exposure to group?
In 2025, I think the short answer is we're going to see a little bit of improvement in the leisure segment that we have not seen in a while, and that's encouraging. And the upper mid-scale segment still gets group business. There's a lot of urban hotels that are upper mid-scale that benefit from convention centers. Just because they don't have in-house group doesn't mean they don't have group. I use the example all the time. When I go out to the Alice conference in January, I stay at the Citizen M. Citizen M, I'm there for, I'm a group employee, right? I'm not employee, but I'm a group traveler, but I'm booking as a transient. Group is what's driving that, right? It's hard to gauge actual group demand based on the booking channels. You have to look at other things as well. We look at not only the booking channels, but day of week stayed, conventions that are in place at that point in time, all those factors to better understand what the group is. And we would say the upper mid-scale segment definitely benefits from group. Just because you don't have in-house group doesn't mean you don't have group.
And that's the last question.
All right, everybody. Well, I thank you all for joining us today. Hopefully we answered your questions. You found the presentation helpful. And again, if we can be helpful in any way at all, please don't hesitate to reach out. My name is Ryan Melliker. This is Katie Harding from our team and from all of us at LARC. Thank you for joining. Hope you found the information helpful, and feel free to reach out to us at any point in time if we can be helpful. Have a great day.